Today we look at why Washington hates this new class of cryptos. These cryptocurrencies are called stablecoins and they give Washington the heebie-jeebies. Why is that? The only difference between cryptocurrencies and stablecoins is that stablecoins are tethered to a strong fiat currency like the US dollar. This is what we found out. What's the issue with stablecoins for the policymakers in Washington? While Bitcoin and other cryptocurrencies make headlines, governments and central banks are more concerned about stablecoins, which they will vigorously oppose. Stablecoins, unlike Bitcoin and its ilk, which fluctuate like roller coasters, are linked to real-world assets like the dollar or gold. As a result, they can be utilized for both regular commercial transactions and long-term commitments. Nobody in their right mind would take out a Bitcoin mortgage, knowing that they would wind up owing 10 times the nominal value of their home. This type of cryptocurrency has grown in value from $28 billion at the start of the year to $110 billion by July. Its use in business transactions is also on the rise. It's easy to see why. When done correctly, stablecoins are the equivalent of cash. It's easy to understand how stablecoins will put present payment processing systems, which are complex, tedious, and expensive, in jeopardy. Stablecoins eliminate the middleman thanks to blockchain technology. Credit card transactions, for example, typically cost retailers between 2% and 3% in fees. Stablecoins will eliminate those costs entirely. Stablecoins will also make cross-border trade and transfers much easier while eliminating fees. The annual savings for individuals and businesses might be in the hundreds of billions of dollars, if not trillions. This would free up massive amounts of funds for new business funding as well as significantly improve productivity-producing investments in current enterprises. As a result, the level of living will significantly improve. Treasury Secretary Janet Yellen's July meeting with the President's Working Group on Financial Markets appeared to have a good intention. To quote Yellen, "Bringing together regulators will enable us to assess the potential benefits of stablecoins while mitigating risks they may pose to users, markets, or the financial system. Some common sense regulations are needed, particularly to ensure that a stablecoin issuer has the assets to back up its coins, just as investors can be assured that a money market fund has the assets to back up its coins. But don't be deceived by the covert agenda at work here. Stablecoins are causing regulators to realize that they pose a danger to not only existing payment systems, but also, and more importantly, the government's monopoly on currency issuance. What are stablecoins? Stablecoins are digital currencies that are linked to a stable reserve asset such as the US dollar or gold. In comparison to unpegged cryptocurrencies like Bitcoin, stablecoins are designed to lessen volatility. Stablecoins attempt to mitigate price volatility by connecting the value of cryptocurrencies to more stable assets such as fiat currencies. Fiat currency such as dollars or euros is a government-issued currency that we're all used to utilizing on a daily basis. Typically, the entity behind a stablecoin will set up a reserve where the asset or basket of assets backing the stablecoin is securely stored. For example, $1 million in an old-fashioned bank, the kind with branches and tellers and ATMs in the lobby, to back up 1 million stablecoin units. This is one method of tying digital stablecoins to real-world assets. A stablecoin holder wants to cash out their tokens, an equal amount of whatever asset backs it is taken from the reserve. A more advanced sort of stablecoin is one that's backed by other cryptocurrencies rather than fiat currencies, but is still designed to track a popular asset like the dollar. Maker, possibly the most well-known stablecoin issuer, does so through a service called Vault, previously known as a collateralized debt position, which encrypts a user's cryptocurrency collateral. The smart contract can then be used to borrow freshly created DAI, stablecoin, once the collateral has been secured. An algorithmic stablecoin is a third type of stablecoin that isn't collateralized at all. Instead, coins are destroyed or manufactured to keep the coin's value in line with the target price. Let's pretend the stablecoin's price falls from $1 to 75 cents. The program will automatically burn a batch of coins to increase scarcity and so raise the stablecoin's price. This form of stablecoin protocol is tough to get correctly, and multiple attempts have failed in recent years. Entrepreneurs, on the other hand, keep trying. UST, founded by blockchain project Terra, is one of the few working examples of this architecture to date. The importance of stablecoins. The USDC stablecoin, for example, is completely supported and can be exchanged for US dollars on sites like Coinbase and Circle on a one-to-one basis. USDC, like many other stablecoins, is based on the Ethereum network. power. Stablecoins avoid the volatility of non-pegged cryptocurrencies while retaining some of their most valuable features. Stablecoins are open, global, and accessible to anyone on the internet 24/7. They're fast, cheap, and secure to transmit. They're digitally native to the internet and programmable. What can you do with stablecoins? Reduce the amount of volatility. Cryptocurrencies like Bitcoin and Ether have a lot of volatility, sometimes even by the minute. Buyers and sellers can have confidence that the value of their tokens will neither grow or fall unpredictably in the near future if the asset is linked to a more stable currency. Assets can be traded or saved. Stablecoins don't require a bank account to hold, and they're simple to move. The value of stablecoins may be readily transmitted around the world, particularly to regions where the US dollar is difficult to come by or where the local currency is volatile. Earn income. There are several simple ways to earn interest on a stablecoin investment, usually higher than what a bank would offer. Transfer money at a low cost. With transfer fees of less than $1, people have sent as much as $1 million worth of USDC. Send to people all over the world. Stablecoins like the USDC are a wonderful alternative for transporting money around the world because of their quick processing and cheap transaction fees. How do stablecoins work? Because stablecoins are cryptocurrency tokens, they all run on the Ethereum blockchain. To provide stability, they must have either an asset that everyone agrees is valuable or a credit guarantee from a very dependable and trusted source. The value of the USD coin, USDC, for example, is intended to remain as close to $1 as feasible. It's backed by real money held in financial institutions. Monthly audits guarantee that all of those amounts are properly accounted for, ensuring that the one-to-one link is maintained. Some stablecoins are even backed by other cryptocurrencies rather than a fiat currency or a commodity like gold. However, it's important to conduct your research because many of these stablecoins are still widely traded. Popular stablecoins. Let's have a look at these stablecoins and which ones are the best known. Diem, previously known as Libra, is a stablecoin under development that was designed by Facebook, the world's most influential social networking site. Despite the fact that Libra is yet to launch, it has had a greater psychological impact than any other. Governments, most notably China's, are already investigating their own crypto-inspired digital currencies, partly because they fear Diem might pose a competitive threat to Facebook, which is a worldwide corporation with billions of users around the world. Diem would be backed by a basket of currencies, including the US dollar and the euro, according to the Diem Association, a collaboration formed by Facebook. However, the group has now eased off from its original ambition due to worldwide regulatory concerns, and now intends to concentrate on the development of many stablecoins, each backed by a different national currency. The Diem dollar, the company's first stablecoin, was set to debut in January 2021. Tether, USDT, is one of the oldest stablecoins, having been created in 2014 and still being the most popular. By market capitalization, it's one of the most valuable cryptocurrencies. The main application for USDT is to move money swiftly between exchanges in order to take advantage of arbitrage opportunities when the price of cryptocurrencies differs on two exchanges. Traders can profit from the difference. However, it has found unexpected uses. Chinese importers stationed in Russia have used USDT to transport millions of dollars across the border, circumventing China's rigorous capital controls. Tether Ltd, the business that produces USDT, was involved in a 22-month court battle with the New York Attorney General on charges that Bitfinex, a Tether sister company, tried to cover up an $850 million shortfall with Tether funds. Tether and Bitfinex were compelled to pay $18.5 million and provide quarterly reports indicating Tether's stablecoin reserves for the next 2 years after the matter was settled on February 23, 2021. USD Coin. USD Coin is a stablecoin that was launched in 2018 and is maintained by cryptocurrency corporations Circle and Coinbase through the Centric Consortium. USD Coin, like Tether before its change to a mix of collateral assets, is pegged to the US dollar and has a circulation quantity of about $26 billion. Circle indicated in a recent investor presentation that the supply will reach $190 billion by 2023. Circle announced plans to go public on July 8, 2021 through a $4.5 billion SPAC merger with Concord Acquisition Corp. The announcement comes a month after Circle raised $440 million in a round led by FTX Digital Currency Group, the parent company of CoinDesk, and Fidelity Management and Research Company. DAI. DAI is a stablecoin on the Ethereum blockchain that runs on the MakerDAO protocol. DAI, which was founded founded in 2015, is a cryptocurrency that is pegged to the US dollar and backed by Ether, the Ethereum token. MakerDAO, unlike other stablecoins, wants DAI to be decentralized, which means there will be no single authority in charge of the system. Instead, Ethereum smart contracts, which encode immutable rules, do this function. However, there are still issues with this creative paradigm, such as if the smart contracts that underpin MakerDAO don't perform as expected. In fact, they were hacked in 2020, resulting in $8 million in losses. Do you have anything to add? If you do or want to share something, feel free to leave a comment. Thank you for watching. We're looking forward to seeing you again. Until then, stay safe.